We are going to tackle as much of this as we can, and hopefully this really helps because this has been a hot topic in the Facebook group, is short-term rentals especially. But a short-term rental in STR typically is rented for 30 days or less, often much less than that, typically under a week, but 30 days or less is kind of what we use. This is one of the most profitable strategies in real estate because it requires the most work. Instead of dealing with one tenant for a year, you're dealing with 50 tenants in a year and scheduling cleaners in between and furnishing and keeping track of towels and inventory and all of these other things. A midterm rental, this is typically a 30 to 90 day stay. Now, this is what I personally do. I love midterm rentals. We're seeing more and more of this strategy come into play, and you guys might as well with your clients because many cities are putting limits on short-term rentals. So if you have to have at least a 30-day stay, short-term rentals don't work there anymore. Midterm rentals, this was huge for travel nurses during COVID. We still get quite a few travel nurses. Also for people who are living somewhere temporarily. One of my current tenants is someone who is here for a internship for college, for a 3-month internship. So you get these midterm stays, and they tend to be priced at a better price point than a long-term tenant because you're offering a furnished unit, but it's a lot less headache. You're not having to have those regular cleanings and all of the extras that are expected in kind of a short-term or vacation property, and you're not facing city limitations for having that short stay. So these are becoming more and more popular. So I'm going to start with the midterm rentals. So tax implications, just like a long-term rental. So if you have a 30 or 90-day stay, tax-wise, you are treating this just like a long-term rental. It is still depreciated across 27 and a half years. It is still a passive rental. The only difference is you'll have some additional costs. They're also going to have some costs for furnishing, some supplies, some cleaning fees, things like that. But as a whole, midterm rentals are treated the same as a long-term rental. Short-term rentals is where it gets tricky. And I'm sure we have all heard about this short-term rental loophole and had clients come to us with it and taxpayers wanting to know about it. The gist of the short-term rental loophole is that if a rental has an average stay of 7 days or less and the taxpayer materially participates, then this activity is by definition non-passive and is not subject to the passive loss rules. And we can often combine this with a cost segregation study, which I'll dive into in a little bit, to create these large deductible losses. So this has become a huge strategy. We love this strategy because normally rental investing has passive loss limits under 469 if your income, your adjusted gross income, was above $100,000 annually. It starts to phase out if you can deduct any amount of losses from your rentals. Once you're above 150, you couldn't deduct any. So what this meant was that people who owned multiple rentals, if they had other high-earning full-time jobs, they couldn't tap into those rental losses. This loophole circumvents that because if we meet these two requirements of under 7 days and material participation, it is non-passive. Now,